Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of March 17th. I want to thank you for joining us, and I want to encourage you to go ahead and like and subscribe to our channel if you find these videos helpful. Also, if you have a few minutes, don't forget to check out some of the other great content here on the JGUA page. With that said, as usual, my intent for these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that, let's get ready to hit the books and get up to speed on the markets. Looking back to last week, of course, we have to start with tariffs. So the Trump administration implemented new 25% tariffs on all steel and aluminum products coming into the United States. Unfortunately, these taxes on American companies and manufacturers will most likely lead to either higher prices on a wide variety of consumer goods or lower profit margins for companies that rely on steel and aluminum in their production process. Alcoa CEO William Oplinger actually suggested this week that it's possible that these tariffs could result in the elimination of nearly 100,000 American jobs. These new tariffs also resulted in some new retaliatory tariffs from Canada and the European Union, with tariff restrictions being placed on American sporting equipment and whiskey. And of course, in response, President Trump threatened to put 200% tariffs on European wine, champagne, and alcoholic beverages. And with this in mind, this is a great textbook example of how a trade dispute, through retaliation, can quickly become a full-blown trade war. Switching our focus to inflation, we saw the consumer price index and the producer price index for the month of February, and both came in below expectations. Although neither of these reports were really good reports, they also weren't necessarily bad reports. The consumer price index showed prices increasing at a rate of 2.8% over the last 12 months, and the producer price index showed prices increasing at a rate of 3.2% over the last 12 months. Although neither of these is at the 2% target that we'd like to see, both of which demonstrated month-over-month increases at a much lower and slower rate, which at least offered a little bit of promise. Now, before you get too excited about the better-than-expected inflation, unfortunately, on Friday, we also saw the University of Michigan preliminary March consumer sentiment report, and it was in fact worse than expected. The consumer sentiment index dropped 11% in the month of March. It has dropped 3 months in a row now, and it's dropped a full 22% since December. Unfortunately, the fear and uncertainty in the economy that's starting to cause consumers to sour is affecting their expectations regarding personal finance, the labor market, inflation, business conditions, and the stock market. Unfortunately, we saw expectations of the future deteriorate across all political affiliations, across all demographic and income and age groups, and across all geographic locations. Specifically regarding inflation, we saw the 12-month inflation expectation increase from 4.3% to 4.9%, which is the highest level it's been since November of 2022. And we saw the long-run inflation expectations increase from 3.5 to 3.9%, which was the largest jump that we've seen since 1993. As fear and uncertainty continue to swell around the economy and the stock market and the potential for inflation, consumers are very quickly becoming more concerned with each month that passes. As I've mentioned on other occasions, traders tend to look at the Chicago Volatility Index, also known as the VIX, as a way to measure uncertainty and sometimes concern within the stock market. In February, the VIX was at about 15. As of last week, the VIX reached a level of 25. Although this does demonstrate a high level of uncertainty and concern within the stock market, throughout the last few weeks, we have seen several attempts for the market to rally, which ultimately were not successful, but indicate that the market is not necessarily in panic mode, but more concern and apprehension. Switching our focus to the stock market, it was another rough week for equities, as all three major indices posted a loss for the week, despite a pretty healthy rally on Friday in all three areas. The S&P 500 and NASDAQ both officially entered correction status, which means that they've both lost at least 10% from their most recent highs, although the rally on Friday helped to reduce some of those losses significantly. Switching our focus over to earnings. As the conversation moves from the fourth quarter of 24 to the first quarter of 25, a lot of the earnings discussion has become very forward-looking. And in fact, according to FactSet, between December 15th and March 6th, we saw 259 of the S&P 500 companies reporting the term tariff as part of their earnings calls. This is actually the highest number of companies reporting this term in the last 10 years, and just one suggestion that the idea of tariffs is currently living rent-free in the minds of CEOs, CFOs, and consumers alike. Not surprisingly, the top four sectors that seem to be the most concerned about tariffs are also the same top four sectors reporting the greatest downgrades to their earnings expectations for Q1 of 2025. The materials, industrials, consumer discretionary, and consumer staples sectors all demonstrated significant concern about the impact of tariffs on their ability to generate earnings and to maintain current costs. It's important to also note that the expected blended earnings for Q1 2025 across the S&P 500 dropped from 11.6 to 7.3% since December 31st. Taking a quick look at the yield on 10-year treasuries, we saw the yield drop early in the week as concerns of economic slowdown dominated the headlines, but then start to gain some of that lost momentum later in the week as concerns of inflation reappeared, ultimately ending the week at about where it started, around 4.3%. Switching over to the alternatives, we saw the market for Bitcoin and crypto in general have a pretty rough week. Although there was a slight recovery towards the end of the week, the value of Bitcoin dropped below 80,000 on several occasions during the week. In addition to this, we saw crude oil finally break its losing streak, but just barely, and it would seem that the markets still have quite a bit of skepticism regarding the supply and demand of crude oil in the future. The dollar also, throughout the week, lost a significant amount of value despite a couple small rallies, the greatest concern being the growing potential for an economic slowdown in 2025. Last but not least is, of course, the market for gold. The market for gold enjoys uncertainty and tends to rise during periods of concern, and that's exactly what it did last week. The market for gold saw a nice bump throughout the week and actually ended the week right around the $3,000 threshold. Shifting our attention to this week. This week's earnings will, of course, be predominantly looking forwards to Q1 of 2025. The big headliners for this week are consumer discretionary firms Nike, Carnival Cruise Lines, and Darden Restaurants, which operates Olive Garden and Longhorn Steakhouse. The reason these consumer discretionary reports are so important is because they give us a relatively close to real-time projection as to what companies are expecting from consumers and consumer spending moving into the first quarter of 2025. Along those same lines, this week's economic reports will include reports on retail spending, industrial production and capacity utilization, as well as our leading economic indicators for last month. Also this week, we'll see some important economic data on the housing and manufacturing sectors. The National Association for Home Builders Housing Market Index will be released, as well as the new data on new home building permits, new home starts, and existing home sales, as well as the manufacturing reports out of the New York and Philadelphia Federal Reserve. Despite all that economic data coming out this week, the big story is probably going to be the Federal Reserve. The Federal Reserve will have an interest rate decision around the middle of the week. And although right now analysts and prediction markets are expecting that rates will stay the same, it'll be incredibly important because the Federal Open Market Committee, or FOMC, will also be releasing their summary of economic projections, meaning that they'll be releasing a report on their expert opinions on where the economy, specifically unemployment and inflation, may be throughout the rest of 2025 and into 2026. It'll also demonstrate what they expect future interest rate cuts to look like given the current economic environment. Last of all, looking a little bit further into the future, I want to take a moment and mention that fear can be an incredibly powerful motivator. We've seen that in consumer sentiment and in the stock market in recent weeks. Uncertainty can also lead, unfortunately, to mistakes and poor financial decisions and more fear. So the reality is that until this new administration can reassure consumers and businesses and markets that there is some predictability in the future and relieve some of the uncertainty, we will most likely continue to see a lot of discussion about economic slowdown, about the potential for inflation, and concern about when this uncertainty may transfer into actual economic backward-looking data. With that said, as I say every week, one of the things we do best is when there's a ton of economic data being pushed out, we grab it, we read it, and we filter it out so that we can bring you what's the most helpful and easiest way to understand for all the economic reports and changes in the financial markets. We do our absolute best here to take the overwhelming amount of information, condense it down to something that's useful and helpful, and help you stay up to speed on the markets. With that said, thank you for joining us this week. Don't forget to come back next week, as of course, something else interesting will happen, most likely interest rates or maybe more tariffs. And we'll do our best to bring it all to you here on Up to Speed. Have a great week.